So the focus right now is on PNB Housing Finance, and Mr. Girish Koski is today in our studios to talk more about numbers. Pull up the last 1 year chart. It is important to note that PNB Housing got completely re-rated ever since Mr. Koski has actually joined. It was much lower actually. If you look at the longer term chart, more than double is what stock has, and because the street is in love with its style of leadership from Canfin to PNB Housing now. But we'll come back and talk about numbers. Mr. Koski, thank you very much for dropping by in our studios today.
Thank you. Thanks for having me here.
Great. So, housing finance is that part of NBFC which the market likes. Other housing finance, MSME and other kinds are going through their own pressures right now. At least the housing part is pretty okay. But you are also trying to steer the PNB's loan book away from premium, which was having a large portion, more towards emerging and affordable. What is the reason behind it, and why do you see that restructuring of loan book is important to take in the next 1 or 2 years?
Thanks for asking this question. If you look at PNB Housing, let's say about 2 years back, we had a lot of challenges. We had challenge on capital raise, we had challenge on corporate book, we had challenge on asset quality both on corporate and retail. We also had challenge on the growth because of higher depletion of book. And therefore, we thought that we should do following things. One, we should run down the corporate book, which was about 18,000 crores. Now, if you see, it is now down to 1,800 crores, almost 18,000 to 1,800. If you look at GNPA, let's say about 2-3 years back, it used to be about 33% in corporate. Today, it is 0. Corporate book is we have run down the book, and GNPA is 0. Even on the retail side, GNPA was about 5.5% 2 years back. Today, if you see retail, I think overall only is about 1.35%. So this was not because of the origination quality. I think after COVID, the efficiency in collections dropped. So in last 2 years, we strengthened a collection architecture and we tried to use legal tools. We were able to collect better, recover better, use legal tools. So we did all of these things. We got growth back, which used to be flattish or negative. Now last year we grew at 14.1% on retail. Q1, if you see, the growth is 14.4%. Generally, if you look at any year, the weakest quarter is Q1 and the strongest quarter is Q4. Q1 we have done well. We have done well on growth. We grew retail book at 19%, overall book at 19.3% in spite of corporate degrowing. Our margins are stable. Our PAT growth is 25%. Our GNPA is down compared to Q4. It was 1.5%. Now it is 1.35. So for us, Q1 was very good, and Q2, 3, and 4 is going to be far better than Q1.
So you've done 19% growth in Q1. You said, what could be the growth rate? Let's say in Q3, Q2, Q3, Q4, with Q4 being the best. And which segment of your book is growing the fastest? Or you're comfortable growing it at a faster pace?
So 19% growth was on disbursements. Our book has grown by 14.4. Our guidance for this year is 17% growth on book on retail.
Okay.
Corporate we are not doing currently. We will start in H2. The book is very small now, 1,800 crores. We will start in H2 and even that will start gaining traction. But it's always going to be very small in the overall portfolio. Within retail, we focus on 3 segments. Prime, emerging, and affordable. We want to grow our affordable book very, very fast. For example, we started this book, this business 2 years back, and today the book is about almost 2,370 crores. So we want to take this book to 5,000 crores by this year end.
So
So
basically,
you're going to double in the next 9 months itself, you're saying? Because you're 2,300,
last
you
year,
said 5,000.
Yeah, last year the book was 1,790. We will take it to 5,000 by this year end.
so largely in the next 1 or 2 years, you will actually become a major retail player, and within that, emerging and affordable will be the largest segments of your business.
True.
How are the unit economics over there in terms of NIMs, in terms of risk parameters as well?
So if we look at the ticket size, for example, affordable is at 13 lakhs, emerging will be 25 lakhs, and the prime will be 35 lakhs. If you look at yields, prime will be at 9.5, emerging 10.5, and affordable eventually it will be at 13%. This year we plan to take it to 12.6%. So if you look at the credit cost, if you talk about the risk, now on prime it's going to be about 18-19 bips. On emerging it will be about 25 bips, and on affordable it will be about 40 bips. I think blended credit cost is going to be about 35 to 40 bips, maybe 2-3 years from now. Our focus is largely on affordable and emerging. This year, incremental sourcing, that is disbursements, we will do close to 40% of affordable and emerging business. So we are reducing prime and increasing affordable and then emerging.
Because you talked about, I think, 1 lakh crore disbursements by FY27 end.
Yeah.
That would also be something which you will get the maximum push from affordable itself.
So if you talk about FY27, our retail book is going to be about 1 lakh crore. Out of 1 lakh crore, affordable we want to take it to 15,000 crores.
1.5.
Emerging 25,000 crores, and the balance 60 will be from prime, and corporate will be about 7 or 8,000. So that's our plan for FY27.
Great. So roughly, just to understand, next 2-3 years, the growth in your book value could be around 20% by all these measures put together. Is that a fair estimate in your view? Or
Yeah,
could be higher?
it should be about 15 to 18%.
15 to 18% is a more fair estimate.
Yeah.
Great. Because we are seeing a lot of interest in the market as well regarding affordable and emerging. We saw recent IPOs coming in, some M&As also actually happening. What do you all mind actually triggering this? Is there a long tailwind in affordable and emerging, and you're also taking initiative to go more towards it? What's the reason behind
See,
it?
if you look at the entire mortgage industry, companies focusing on affordable segment, and if you see the book, I'm talking about what these companies have built over a period of time, is little over 1 lakh crore. And the total mortgage book is in excess of 28 lakh crore. So which means on affordable there is huge opportunity which is still untapped. In last 10-12 years, I think a lot of companies have figured out how to make affordable business profitable. In fact, now it is very profitable. In fact, a lot of companies are now getting into affordable and emerging. Same thing is true with PNB Housing also. I think the important point is budget announcement. So there is an investment of
10 lakh
10
crore.
lakh crore.
Over 10 years.
Yes. And government allocation would be 2.2 lakh crore. We should see in last 2 terms, PMAY started in 2015.
Yeah.
It was there for 7 years. They had committed 2 lakh crore. Released amount was 1,65,000 crores. Out of that, PNB Housing, we did loans worth 13,000 crores. Now, the announcement allocation is 2.2 lakh crore, which means there are 3 benefits. One, the allocation for the housing finance companies is going to go up.
Sure.
Now, this will ensure that the cost will come down because this will come at a lower cost. That's number one. Number two, unlike the last 2 terms, this time the intensity of marketing efforts directly from the government is going to be that much more higher. Which means this will propel growth. So this will get additional growth to all the housing finance companies. And the third, the margin this time on PMAY is expected to be far higher compared to the earlier 2 terms. So all the companies where the margin today is, let's say, less than 4%, they tend to gain. So there are 3 benefits clearly, and therefore PMAY is going to help all the housing finance companies, provided they do focus to do this. For example, in our case, we have 303 branches. All the branches we have geared up to handle PMAY loans.
Yeah, and for you the benefit is also because you got the ratings upgrade, your cost also has come down in terms of funding. But talking about funding, of late the measures that have been taken by the RBI has made funding a bit more tight, and that is something we were discussing with the management of Chola as well earlier in the day, that the funding condition has become a bit tight. What's your situation? Because to give that 1 lakh crore retail deposit by FY27, you'll need the funding. Are you planning some sort of fundraise, or where do you expect it to come from?
No, we have growth capital now. We raised, we did rights issue last year.
Yeah.
Our CAR is now 29.5%. Having said that, I think for us, whatever is the source of funds has never been a challenge at all. In fact, if you look at our cost of borrowing, last quarter it was 7.98. This quarter it has come down to 7.92 on the portfolio. Incremental, it was 7.93, and this quarter it has come down to 7.75. So we have reduced the cost, both incrementally as well as on the portfolio. So we expect that going forward, one, we are restarting corporate. Number two, we are changing segments and moving more towards affordable and emerging, which will give us better margin. Number three, PMAY. This will ensure that there is some leeway on the cost to come down and margins to improve.
Okay, one last word. Apart from that plain vanilla product, loan product which you have, would you also have a scope for any kind of a fee-based income over and above?
I think the only fee-based income, other than the processing fee, what we take from customers for processing the loan, is insurance bundled product. I think this is the common thing. Nothing beyond this.
Okay. All right, Mr. Kaushik, thank you very much for dropping by today.
Thank you so much for being with us. But just a quick look at the market.